Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. European and US futures are in the green and Treasuries rally after Donald Trump chooses hedge fund executive Scott Bessent for Treasury Secretary. Bessent has indicated he'll back tariffs and tax cut plans, but is seen as a fiscal hawk. The president-elect's pick helps drive down yields and pushes up stocks. The Bitcoin rally eases and gold dips, with market focus turning to the next Fed move. Plus, Italian banking consolidation is in play, with UniCredit saying it has begun an all-shares takeover bid for domestic rival Banco BPM.
Morning, Anna. Let's talk about the financial markets. You just laid out some of the details as to how markets are reacting to the news that Scott Bessent will be the Treasury Secretary. Stocks are up, the dollar is down. Yields are a little bit lower, i.e. Treasuries are catching a bid, 210s are inverted. The gold story looks like a little bit of an anomaly in some ways. It appears to be reacting to the possibility that we are making progress when it comes to ceasefire talks in the Middle East. The countdown to the opening trade starts right now. Monday morning, good morning. Financial markets are giving thanks for Scott Bessent, our new Treasury Secretary, America's new Treasury Secretary, having global implications, it seems, when it comes to financial markets, as we've already been laying out. A big reaction in the dollar. We are seeing Treasury yields coming lower. Stocks appear to be bid.
Yes, absolutely. Stocks do appear to be bid. This is being seen as the market's guy. The fact he's a fiscal hawk seems to be having some impact on what we see in Treasury markets. He's been talking about three arrows, and that's around the deficit, keeping that under control, getting growth higher, getting oil production out of the United States higher. Seems to be taking some lessons from Japan in all of this. Real questions, though, as to what this means for a Fed chair, the next Fed chair, and when we get that name. That's an interesting conversation. But also, are there two sheriffs in town? Is this all about Trump? How much of a say is Scott Bessent really going to have at that top table? All of this still in play.
The Journal, who appears to have an interview with him, seems to be suggesting that the priority is tax cuts. The tariffs don't appear to be front and centre in the way that maybe Trump has positioned them to be. And it's going to be interesting to see how that dynamic plays out. This is being perceived as being good for China, potentially better for Europe as well, in terms of the way that some of those tariffs are being imposed. But he does want to get the deficit under control. He does want America to grow out of its current deficit and debt issues. How does it do that? And what does that mean for inflation? Does that imply that we are going to be more comfortable with higher inflation, and that gets embedded into the system as well?
Yes, so that's certainly something to keep in mind. I was listening to some of his previous appearances in front of the media where he talked about some of his least favourite words in investment management being never and always, which does give a sense of the pragmatist, perhaps, or somebody who appreciates the nuance and the complexity, obviously, given the job that he does, of where markets move. So really interesting to see the way that markets have reacted to this guy, because markets have reacted to this as if this is a sort of moderator on the Trump trade. We still have the Trump trades in place, but there's some moderation in them as a result of this new Treasury Secretary.
So risk assets like the Trump trade, but not all of the Trump trade. This takes out maybe some of the downside to the Trump trade and therefore allows risk assets to keep rallying. Risk assets just want to keep rallying, it seems. So yields are lower, though, so bonds are catching a little bit of a bid. Stocks seem to be reasonably well bid. What is interesting is that the dollar is rolling over a little bit on this, which I think is fascinating. But is that something that will be sustained? What is his perception of how powerful a tool the dollar is? I think we don't know yet.
Yes. Not sure exactly his stance on the dollar. Is this to do with changing perceptions and interest rates and what this does to the Fed's narrative? But you raise interesting questions about inflation on that front. People asking, and we've seen the yen gain on the back of that dollar move, and some people saying, well, this isn't going to be sustainable for the yen. This isn't going to be something that pushes the yen up sustainably. We actually need to see more action from the BOJ, a hike from the BOJ, to achieve that kind of
and I think it probably has implications as well as to what the ECB does next as well. There has been this perception growing that maybe the ECB delivers a series of 50 basis point cuts. Does this change pricing around that? Does a stronger euro maybe take some of that off the table today? We'll see how that gets priced as well.
Yeah, absolutely. And interesting to see the moves we're seeing in oil and in gold. I mean, some of this comes down to FX, doesn't it? When you see a big move in the dollar, you're going to get movement in those areas as well. But that's something to keep an eye on.
Oil is interesting in as much as he is basically, he wants, one of the three arrows is to produce an awful lot more oil. I'm not sure the gold trade is related to all of this. That feels maybe like it's ceasefire talks.
Right, and we'd had a lot of ramp up in the gold price last week on geopolitical concerns around Ukraine. So there's a little bit of a pause in that narrative, perhaps. banking consolidation. Andrea Orcel, busy with Germany, but now busy domestically in Italy as well.
So is it one or the other? And what does it mean in terms of the UniCredit story? Is this a hedge against the UniCredit story, or is this in addition to the UniCredit
story?
The Commerzbank story. I misspoke. What happens next, I think, is going to be fascinating, because this is more of a domestic play, but it's also a roll-up play, because you've got Monte de Paschi potentially involved here, you've got wealth managers involved in this, BPM has been pushing its own consolidation story, so this could have wider implications in terms of the consolidation story within Italy itself.
And he's been talking in the last sort of few trading days about Commerzbank and where the expectation is there. He said that this is Orcel. He said that he's not going to pursue this until after the German election. I mean, it seems that many parts of the current German government aren't keen to sell any more of the stock that they hold, so maybe that's not so much of a choice, but that's the reality. And we heard from Bettina Orlopp on Friday. Whilst we were busy talking about lots of other things to do with the macro economy in the Eurozone, we were hearing from Bettina Orlopp, who was talking about increasing payouts to shareholders. So I think we still have huge questions around whether Commerzbank actually progresses to be anything bigger than it is right now.
Why no premium on this deal as well?
Yes, I'm not sure. I have messaged colleagues in Bloomberg Opinion to see if they've got a view, because there isn't one that I could spot. OK,
once we get an opinion, we'll bring it to you. What else have we got coming up on the show? Paul Skinner, Wellington Management Investment Director, is going to be joining us. Jack Inglis, Alternative Investment Management Association CEO. Plenty to talk to him about. Patrick Armstrong from Plurimi will be joining us as well, as will Tim Ash, RBC Blue Bay EM Sovereign Strategist, and very much a Russia-Ukraine watcher. All of those joining us throughout the programme.
Let's tell you what else is coming up this week. It's a busy one for some of the data points that we watch, and today we focus in on Germany. So the German IFO data will be out later on this morning. We'll get FOMC minutes on Tuesday. That no doubt will be a highlight. We'll get plenty of US data this week, even though we have Thanksgiving on Thursday. So the US GDP print and US PCE both coming out on Wednesday. They could be of interest. It is Thanksgiving on Thursday, and then of course everyone goes shopping on Friday. So that's all we really need to know about that. Plus Eurozone CPI. That's something that we'll focus in on. But there will be this German focus at the beginning of the week, when we had the weakness in that German data coming through on Friday, plus the weakness in the French data, of course, perhaps one more severe, really putting Europe and expectations around the ECB front and centre.
Are we going to get a pickup post-election in Germany in some of this economic data? I think is one of the questions.
And are we going to have a stall into the election?
Precisely, and I think therefore do we kind of have to wait for that to arrive before we get some clarity on what happens next? It's going to be interesting to see what the institutes have to say. Clement Fuchs is going to be joining us a little bit later on. I think Critty's going to be talking to him to get his take on what is happening here. But it's interesting, there's also a story on the Bloomberg this morning talking about the fact that the bond market's prepared to write Germany a very big cheque. If you want to spend, the money is there and available for you to do that. How does that money get spent, I think, is an open question. Clearly, infrastructure is going to be part of the story, but defence as well. Could Germany be about to go on a spending spree? It just doesn't feel like it at the moment. And
we have defence ministers, I think, as well as G7 foreign ministers all meeting today. So there are lots of separate conversations happening around the defence theme today. PCE out of the United States will be interesting on Wednesday. Expected to tick up a little. All of this in amidst all of the complexity of pricing in Trump trades, thinking about what Scott Bessent means for those Trump trades, what inflation impact do both of those dynamics have, and then thinking about the Fed's reaction will be really interesting. And Bloomberg Economics suggesting that amidst all of that, they're sensing a lot of language from Fed officials around possibly pausing in December. So we'll see whether that...
December's increasingly not being priced.
Yeah. You think that the year ended last week, don't you?
Well, I thought...
Oh, you did last week.
Once Nvidia was over. I think we can... What is the latest? What could cause volatility? We've now got a Treasury Secretary that removes some of the risk from maybe going into the Trump inauguration in January. I don't know. Do you put your feet up? Do you go shopping, as Anna says, on Friday? Enjoy yourself? Let's talk about what else we need to know this morning and figure out what is going on. The COP29 summit has ended with nearly 200 nations agreeing to triple the amount of money available to help developing countries confront rapidly rising temperatures. The final draft calls on rich nations to commit at least $300 billion a year in climate financing. The deal came after 2 weeks of intense and sometimes hostile negotiations. Romania's presidential election has delivered a political earthquake as right-wing candidate Călin Georgescu came out on top in round one with 22% of the vote. The nationalist, who has voiced admiration for Vladimir Putin, will now enter a runoff with the current Prime Minister in early December. Georgescu's campaign has focused on young voters and has questioned military support for Ukraine, sparking concerns around Romania's membership of NATO. And shares in Chinese electric vehicle makers are higher today. This after Reuters reports that the EU and China are nearing a potential EV tariff solution. The chair of the European Parliament's Trade Committee is quoted as saying China may commit to having a minimum price floor for vehicles that it imports into the bloc. Does that effectively mean that we are going to be paying more, that Europeans are going to be paying more for Chinese cars than maybe the Chinese are for the same vehicle? It does seem to imply that.
It's really interesting. How this pitches to the electorate is going to be really interesting, because I can see how this makes sense to German car manufacturers, or to car manufacturers in Europe broadly, if they don't want to face quite so much price competition from the Chinese. But it's a strange one for politicians to be delivering the message that, you know, we have managed to deliver you a price floor on your vehicles coming out of China. I mean, that seems a bit strange.
So you want the cheapest car you can buy?
The gap between them is huge.
Yeah.
20,000 euros in many cases, the gap between these lowest priced vehicles in China and in Europe.
If you don't have a domestic car company, if you don't have a domestic auto manufacturing base, are you going to be okay with this? Like, is this going to be something that you're going to be on board with? Again, I think this is going to drive a wedge between countries like Spain and Germany and countries that really feel that actually they just want to progress with the EV transition and get on with it as quickly as they can. Yeah, and we should say that this is all it's a Reuters report, and it does make the point that these are talks that are ongoing. Yep. There's a really big gap between these prices, and that, you know, even if closing that a little bit will take a very long time. So that you don't get a sense that this is imminent, that some deal is coming right now. It also doesn't encourage the Chinese to come here and build cars, which I thought was the objective.
Yes.
That they would come to Europe, set up manufacturing plants.
Yes.
They can just manufacture in China, bring the cars here, take the minimum price, which is going to be way above the manufacturing price, and pocket the difference.
We just got a line out of Commerzbank, which I think is interesting, or at least a line about Commerzbank, falling on TradeGate this morning. Suggestions then that this stock is going to go weaker at the start of trade, Guy, which is interesting because, you know, does the market take from this that Orcel is going to be focused on domestic Italian M&A and therefore less so on Commerzbank? But was Commerzbank going to move anywhere very quickly anyway, I suppose you would ask? And Orcel was also saying that he was not going to reduce the amount of payout to shareholders given all of the M&A that he is doing. He said this before we got the news on Italy today, so I wonder if that was sort of designed to comfort investors ahead of this news.
And the margin, if you're in merger arbitrage, you're going to look at this and go, the odds have changed, so we're going to take the price a little bit lower. That seems logical. Does this mean one or the other? I don't know. But just in terms of just the odds of one or other happening, yeah, it seems logical that you would price out a little bit of Commerzbank and price in maybe a different deal. Yes, assuming you can't do everything all at the same time, which would seem a logical assumption. Coming up on the programme then, Amazon prepares to go toe-to-toe with Nvidia. That is the focus of today's Big Take story. We'll bring you more on that. Plus, we'll check on the Italian banks at the open after UniCredit's BPM bid looks to reshape the sector domestically within Italy. What are the implications? Up next, though, markets are reacting to Donald Trump's pick of Scott Bessent to head the Treasury in the United States. We'll dig into the details there. And if you have any questions, if you want to be part of our guest conversations, then please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. "16 minutes past the hour. Welcome back. You are watching the opening trade. Let's talk about how we are positioning ahead of that opening trade. Markets certainly so far reacting positively, or risk assets reacting positively to the choice of Scott Bessent as Donald Trump's Treasury Secretary. I'm excluding, of course, the dollar from all of this. Let's get more details now from Valerie Tetel.
That's right, Guy. We surely are risk on after this announcement of the Treasury Secretary being Scott Bessent on Friday. S&P futures are solidly in the green. We're also seeing an outperformance in small caps, up nearly 1% so far in this morning's trade. That has a lot to do with the fact that Scott Bessent has really backed deregulation and pushing through these tax cuts, really being able to push U.S. economic growth through Main Street. So seeing a boost when it comes to small cap stocks. Bloomberg Dollar Index is softer today. A lot of that has to do with the market believing that Scott Bessent will take a more gradual approach to tariffs. We're also seeing quite a sharp rally in the Treasury market. We've got the 10-year yield down 7 basis points. But let's take a look in my next board at the whole curve, because this rally is being led by the long end. Really a vote of confidence from the bond market that Scott Bessent is a safe pair of hands. Guy, he actually entered politics, entered the Trump campaign because he thought that the U.S. was running out of time to fix its debt trajectory. This is a vote of confidence from the bond market market that he could be the guy to fix it. He also has an economic policy of a 3-3-3 agenda I want to go over very quickly. He's taken a note maybe from Shinzo Abe and having a very clearly communicated economic policy. He wants to cut the budget deficit to 3% of GDP, spur 3% real GDP growth, and produce an additional 3 million barrels of oil per day. Now, Guy, this 3% of GDP of a budget deficit would be slicing the budget deficit in half in just 3 years. Maybe you think that's gradual. Many might think that would be a sharp reduction in government spending. He has also talked about tariffs this could be the time to revitalize Alexander Hamilton's favorite tool. He said this in an op-ed in Fox News, saying we should not be afraid to use the power of tariffs to improve the livelihoods of American families and businesses. He has been pro-tariff Guy, but if we read through the lines on what he's written recently, is that he wants to use tariffs as a negotiation tool. So he maybe not be, I guess, a fan of slapping tariffs on hard and fast as soon as Trump gets to office, but using them as a negotiation tool for foreign policy.
Financial markets love it, though. Valerie, thank you very much indeed. Let's get more on the market's reaction to Scott Bessent heading the US Treasury. We're joined around the table by Paul Skinner, Fixed Income Investment Director at Wellington Management. Should we give thanks for Scott Bessent?
Certainly the markets are going to give thanks. I mean, he is a proper compromise candidate who's going to do probably the right thing for the markets and encourage risk assets to carry on the rally they've got, which is what markets want at the end of the day. I think a lot of what he's saying is difficult to implement.
Yep.
Cutting that budget deficit to 3% while still giving tax cuts is going to be an enormous challenge.
Don't tariffs offset that? Aren't tariffs the offset for the tax cuts?
I think the tariff story, when Bessent talks about it, is one of compromise. But at the end of the day, Trump is going to be running this. This is going to be art of the deal by Trump. And so I think we're going to be in the sway of, are tariffs coming on? Are they not? And it's going to be Trump's decision at the end of the day. So I think Bessent can talk a good game, but we are going to be having to watch what Trump is going to decide, and that's going to give volatility to the market.
Yes, I was reading something by Steen Jacobsen, who comes on the show fairly often, and he was saying that exact thing, that there's only one sheriff in town, actually. And so is the market right to price this in as a sort of moderator on the Trump trade? This isn't, nothing that we're hearing from Scott Bessent is in complete opposition to the Trump trade. It just moderates it around the edges?
Totally agree. So he's a moderator. That's why we're getting this lovely risk-on feel, and bond markets are enjoying it. And so moderation, I think we'd all like to see. But at the end of the day, we have Trump in charge, as you rightly say, and he is going to be the arbiter. And so we're going to see volatility. You know, these tariffs can take 1% off global GDP. These are big market-moving questions. And so I think volatility, as we go forward with this risk rally, is true. But I think as we go into next year, there's a bigger issue.
And the bigger, is that fiscal, the bigger issue? Is that what you're thinking about?
The fact is, we've seen huge political turnover, incumbents chucked out, and many new political parties are pushing on that fiscal stimulus across the board. At the same time, we've got monetary stimulus from central banks cutting rates, and we haven't conquered inflation. Inflation still sits above targets around the world, and in an environment where we're at the lowest unemployment in developed markets for 35 years, we're going to see, in our belief, an uptick in inflation. And that will then tie the hands of the central banks, and markets have not got that in their thinking yet.
I'd have thought stocks would love that kind of environment, wouldn't they?
For the beginning, yes. I think we can roar
Is the risk rally
We
still
will
on?
roar into 2025 with a lovely risk rally. But then the music may well stop in the middle of next year. And that's going to be an interesting point. Could it be lots of volatility, or could it be a reversal in the trend that we've seen in risk assets? And that's going to be the question. And that depends on how sticky...
Okay, so what's the answer to that question?
I think risk rally as we go into the new year...
Right.
But I think it runs out of steam at some point in the middle of the year as the market realises central banks cannot be the provider of liquidity at last resort, and they are going to have their hands tied. So there will be a moment when the music stops.
And where does the fiscal music stop? Where do the bond markets come in and make things difficult? Are we heading for a debt crisis somewhere?
No. Deficits have changed dramatically. Remember, when Trump came in the first time, I think the debt to GDP was about 75%. It's now 100%, and we've got a 7% budget deficit. So we're going to be at 135 in 10 years' time. That's worse than Greece and at the same level as Italy. So I think there will be a time when the bond markets look at all this fiscal spending, they look at the size of deficits around the world. I mean, I'm talking about other countries other than the US. And the bond market vigilantes who we saw in the trough.
We've heard this music playing for a long time. The music that eventually the bond market's going to wake up. The deficits do matter. The US has been running a deficit for ages, and a really big one, but it doesn't matter.
During COVID, we sort of parked that thought. Yeah. It felt like this was extremists, and bond markets forgave governments for going out and borrowing a lot.
We have another big shift that's happening, and that's all to do with Japan. Now, Japan is the biggest saving nation in the world, right? And for many, many years, decades, they've shifted their savings offshore and supplied capital to the US, UK, all these various offshore. Now, we're seeing, as rates rise in Japan, and they're going to have to rise, that money shifting back domestically. We've seen $60 billion shift in the last couple of months out of treasuries, which is only 5% of what they hold, but it's going back to Japan. And so you've got to fund these deficits. At the same time, one of the biggest savings nations is pulling money back into their own domestic economy. This is why we could be coming to a head.
Is this a Liz Truss moment?
Yes, but can it be a Liz Truss moment for the United States, or is it actually going to be a Liz Truss moment for somewhere else?
You're right. There are other candidates. There are other candidates who probably are further along, and they are not the reserve currency.
Yeah.
So you're right. The weakness may show somewhere. Already, we're looking at all developed market sovereigns like they're emerging. You know, we're looking at willingness to pay, ability to pay, all these analytics that mean you've got to look at very carefully at different places.
How does the US economy react to a lower stock market?
Well, I mean, that's going to be a huge question. When Trump's in
do we get a lower stock market? Yeah.
I think, you know, in our prediction, that's going to happen as we. You've got
order of magnitude of what?
Let's go back to when Trump first came in. I think S&P PE was about 26. It's now 38. If you look at equity risk premium, we're in the bottom decile for 100 years. Last time we were in that particular, you know, equity risk premium low point was 1987, 2000, 2007. What happened to equities after that?
Big drops.
Correct.
But are we going to get that kind of drop under a Trump presidency that is very keen to use this as its key barometer?
Volatility, definitely. Big drop, potentially.
OK, thanks so much, Paul. Thanks for joining us. Good to start the week with this conversation. Paul Skinner, Fixed Income Investment Director at Wellington Management, digesting, and the market is digesting, the appointment of Scott Bessent, but thinking about what all of this means longer term for bond markets. Let's just update you on some of the trading we're seeing around the Italian banking sector. It seems that UniCredit shares could drop at the open, that to be expected. Banco BPM could gain maybe up 8% or so compared to the Friday's close.
Why?
Still looking for answers on what exactly is happening with the Italian banking sector. We have a consolidation story underway, but some of the dynamics perhaps a little bit opaque. So we'll keep revisiting this and finding new voices to bring you on this very theme. Coming up on the programme, the CEO of Binance tells Bloomberg that Donald Trump is a big positive for crypto. We'll bring you some of our interview with Richard Tang. That's next. And we'll discuss what the Trump trade means for alternative investments and for regulation more broadly. Jack Inglis joins us. This is Bloomberg.
Monday morning, good morning. 30 minutes to the start of trading here in Europe, 30 minutes to the opening trade. Let's talk about what futures are telling us about how equities are going to perform this morning. As you can see, a largely risk-on scene in front of you. We seem to be giving thanks for Scott Bessent this morning. Risk assets around the world seem to be doing reasonably well. Treasuries are also catching a bid, which is feeding back into what is happening here with the European bond market too. We are starting to get some trades coming through in terms of the German story, what's happening in France and Italy. The expectation is that you're going to see a ripple coming across the Atlantic as we see Treasury's better bid on what appears to be a more compromised candidate, maybe someone calling Scott Bessent.
Yes, let's talk a little bit about what Scott Bessent's appointment and a Trump presidency means for a number of risk assets, including the crypto space. Bitcoin's rally has stalled after nearing the historic $100,000 level. President-elect Donald Trump's support for crypto has been a key driver of the recent gains, of course. In an interview with Bloomberg's Francine Lacqua, the Binance CEO Richard Teng discussed what Trump's election means for crypto.
President Trump being elected certainly give a boost and give greater clarity to this. But I would say that 2024 has been a landmark year, and that momentum started earlier this year. So if you look at what happened in January this year with Bitcoin ETF being approved, firstly in the United States and then subsequently all around the world, from Brazil to Canada to Australia, Hong Kong, and the list goes on. It gives a lot of recognition and finally the respect that this sector deserve all along. And with the likes of all the largest money manager and all the top financial institutions around the world starting to recognize the value of this space, you have Larry Finn, CEO of the largest money manager, BlackRock in the world, that went from a crypto skeptic to a crypto believer. I think that itself speaks volume. So if you look at the Bitcoin ETF, it's the best performing ETF so far I think in the history of ETF, right? Again, it shows that institutionalization has started and mainstreaming has started.
Could the Trump administration change everything for cryptocurrencies?
Well, it's a big positive. I think the last 4 years, especially if you are in the United States, I think the last 4 years has been pretty tough, right? In terms of, regulation via enforcement, which is not necessarily the best form of regulation. But we have a very pro-crypto president. And if you look at, it's not only President Trump himself, but the House of Representatives, 2/3 of the legislator being elected are pro-crypto. Same story is happening at the Senate level. Many pro-crypto legislators and policymakers are being elected.
That was the Binance CEO, Richard Teng, speaking with Bloomberg's Francine Lacqua. Now, Trump's incoming administration is seen as a crypto tailwind across Wall Street and beyond, as we were just hearing there in that conversation. The president-elect's pick of hedge fund executive Scott Bessent for Treasury Secretary has also helped sentiment in various global markets. With that in mind, let's bring in Jack Inglis, who's the CEO of AIMA, the Alternative Investment Management Association. Jack, nice to speak to you this morning. So we have a hedge fund guy running the Treasury, and you represent hedge funds and other alternative investment managers. I imagine you welcome this news.
Well, the markets have certainly welcomed them. I think we've seen that from the figures that you were just showing just now. And of course, I would say, yes, we would welcome a hedge fund executive as the new Treasury Secretary. I think beyond that, I mean, really, he has a deep familiarity with financial systems, macroeconomics in particular, which was his hedge fund speciality. He knows about currencies. Let's not forget he worked for George Soros at the time that the pound was so greatly attacked by him. But I think he's seen as a very good candidate in the sense that he will prioritise both economic and financial stability and market stability, and you can see that welcomed by the markets.
Yes, I wonder if they're nervous at the Bank of England right now with his appointment. We will see. But thinking about what he brings, you've outlined some of the skill set he brings, and the weekend press coverage and our Bloomberg coverage was full of all kinds of fascinating anecdotes as to the way he thinks and the things he thinks and how that might all play out. I suppose we're still not entirely certain his views on tariffs, and that seems to be the thing that the market worries about. Do we have any insight as to what somebody schooled in the way of in the ways of hedge funds might bring to that tariffs conversation?
I don't want to speculate what's going through his head, but I think most hedge fund managers believe in free markets, and so perhaps you can read into that what you think. Certainly, I've read the same press as that you have, and particularly the Bloomberg press. I think he might actually put a reasonably sort of defence against being overly aggressive against tariffs, but that remains to be seen.
What would you like him to do? What do you think he needs to do to improve alternative assets in the United States?
Well, for us, really, it's less about the Treasury Secretary, although that's a very important role. It's about the regulator, so particularly at the SEC. So at the same time, last week, or roughly the same time, we had the announcement that Gary Gensler was stepping down from the SEC. So it remains to be seen who will be appointed.
You almost appear to be smiling about this.
I beg your pardon?
You seem to be almost smiling.
Yeah, I think that's absolutely fair. The past 4 years have been difficult. I'm sure you're very aware that Gensler has adopted and pursued a very aggressive and indeed contentious package of new rules. So we won't miss him, is what I'd be quite frank in saying.
This does appear to just highlight again the gap that exists across the Atlantic between what happens here and what happens over in the United States. Christine Lagarde was on her feet last week talking about the need for consolidation amongst European trading platforms, the lack of financial market savvy that exists on this side of the Atlantic, well, not this side of the Atlantic, within the EU. Does this further enhance that gap? And does it further put pressure, do you think, on Europe to get its act together? Do you think it will? What is happening over there? You've got a Treasury Secretary who's a hedge fund guy that has an idea of how financial markets work efficiently. Just the compare and contrast is now epic.
I think that's sort of somewhat true, but if you actually look at who the new Financial Services Commissioner who's coming in, who was confirmed a little bit earlier on this month, Maria Albuquerque does have financial services experience. She was finance minister in Portugal at a time of great importance when there was a sovereign debt crisis going around most of the EU. So it's not as though that expertise does not exist. It's just somewhat different. But to your point of divergence between the EU, perhaps between the UK and the EU and the US, I think the incoming administration that we're going to see under President-elect Trump is going to accentuate that further. And I think it's going to be really, really interesting to see how we in the UK respond, how the EU respond to perhaps a very deregulatory agenda under Trump.
And what about crypto regulation? I mean, we were just hearing there from Binance about how they expect crypto regulation to develop, and post Gary Gensler at the SEC, how that will all change. But there are still other bodies. You know, the Fed has asked questions about crypto and the extent of the stable coins. They have concerns about whether those have sort of built-in instabilities, and there are still a lot of institutional investors with doubts about whether crypto forms a rightful place in their portfolios. How do you expect the crypto regulatory space to develop?
Well, it's all changed, is it not, in the United States under Trump, in the sense of his approach to crypto, which is very well flagged. I mean, I think the important thing to note about crypto regulation, the frameworks that exist around the world, that there's still pretty early stages. Certain countries are much further ahead in developing them. Actually, the EU is quite advanced in that front. Switzerland, Singapore, the United Arab Emirates. But the UK is trying to catch up and put in the right frameworks. The US is going to come from behind, but it's going to come very, very quickly.
Do regulators just have to accept that this exists and they need to build frameworks to regulate it? Or is that what the SEC was trying to do and that got too tough?
Well, the SEC's approach was actually not to regulate it. They said that these were securities anyway, and they went after it through enforcement, regulation by enforcement. And that was one of the big criticisms about Gary Gensler, was just the high degree of enforcement activity that he pursued, particularly in the crypto space. I think there were over 100 outstanding crypto investigations. And that's no way to regulate. You want predictability. You want a framework in place under which people can operate. Yep. And certainly, from what we hear from firms, is that they want regulatory certainty around this. And that really hasn't existed in many places.
So a more positive message from the White House to US regulators. Is that something we're going to see here in the UK as well? I listened to the Mansion House speech that the Chancellor gave a few days back. The message seems to be, you want to focus on growth. We need a less regulatory environment. We need to remove some of the burdens that have been put in place over the last few years. Can I compare and contrast these two messages?
Yeah, there's a lot going on in the UK. The Mansion House speech, as you talked about, the whole secondary objective of the FCA, and there's a call for evidence now coming out for the Treasury about that strategy. The FCA are consulting about their asset management regimes. The House of Lords are looking at...
what message would you send?
What message would I send?
Yeah.
I totally agree that the pendulum post the global financial crisis towards risk aversion had swung way too far. And actually, that's what we heard from the Chancellor.
Yes.
So there needs to be a reset. I welcome what I'm hearing, but the just high-level sort of consultation levels going on at the moment rather than concrete proposals. So that's what we need to see. I think we need to see them fast. The Chancellor talks about a 10-year sort of outlook for financial services. Well, Trump's only got 4 years, and he's going to work in a hurry.
And the growth mandates for these bodies in the UK, is that going to make a big difference, making sure that people are not just focused on regulation, but also on the growth agenda? Is that going to be material?
Yeah, I think it would be unfair to ask a regulator to single-handedly promote growth in this country. It's a function of policy, of tax, of talent being in place, as well as regulation. But I think it is an important objective for the FCA to have.
Do you think there should be a greater focus by government on investing in the UK? Do you think there should be a mandate to invest in the UK? Alternative assets encapsulate taking an awful lot of assets, including a lot of private equity assets and obviously a lot of infrastructure assets as well. Do you think there should be a requirement to invest in those assets here?
Yeah, I think you're really referring to kind of the pension fund reform, and should they be mandated to invest in the UK?
That would promote growth.
It's a really interesting. It's a really interesting question. Take a country where there is no mandate, but where it's got a pension scheme, a pension system which we'd like to emulate, and that's in Canada. Do you realise that Canadian pension plans invest more in China than they do in the domestic economy? So perhaps that leads to an argument or a debate about whether you actually need to mandate it. There is resistance to that in certain quarters. A new product in the EU, the LTIF, which is the European Long-Term Investment Fund. The French tried to have that structured so that at least 30% would be invested in the EU. The rest of the EU actually went against that, so that actually hasn't entered into the structure of the product. So it's a big debate. Really, fiduciary duty is the most important part of pension plans, and getting a return for their beneficiary savings is by far.
And this is harder under another Trump presidency, perhaps, in the short term, if this is going to push up risk assets in the United States. Maybe the money flows there.
I think that's right. I mean, if you look at how the US stock market has benefited investors wherever you are on the globe, the US has been the place where the returns have been made.
Great to see you, Jack. Thanks for stopping by to see us.
Thank you.
Appreciate it. Jack Inglis, CEO of the AMO, the Alternative Investment Management Association. Let's talk about what we're seeing in UniCredit shares this morning. A little lower on TradeGate. You're seeing a bit of movement in Commerzbank as well. We're watching Banco BPM rise on TradeGate, but this, in theory, is a deal without a premium, so why are we seeing that? Anyway, there's lots going on. Plus, also, we've got some big mining moves as well this morning that we need to discuss. We'll do all that in just a moment, figure out which stocks you need to be watching into the open. That's coming next. This is Bloomberg. Bit of banking news that we need to keep you up to date with this morning. There is a call that is happening at the moment. Orcel is on it. Not entirely sure who he's talking to, but I'm assuming the reporters are on that call as well, because a series of lines are dropping. UniCredit's Orcel saying he cannot be absent from Italy's banking consolidation story. Interest in Banco BPM, quote, should not be a surprise, seems to be the line from him. Is this a zero-sum game? Is it Banco BPM, Commerzbank? If you do one, you can't do the other. Are regulators going to be okay with doing both? Is there enough bandwidth to do both? Is there enough money to do both?
Yeah, some of our opinion columnist colleagues suggesting that perhaps there's enough capital, but maybe regulators might not like them to do it all at the same time, and that might be something to think about. So maybe we will see Commerzbank track weaker at the open as a result of that. That's the banking consolidation story that we're working into markets then, and we'll certainly keep an eye on those stocks at the open. More broadly, though, it's the Scott Bessent trade that really has markets captivated. Joining us now, our Markets Live executive editor, Mark Cudmore, with thoughts on the markets. And Mark, which of the dynamics that we're seeing in play right now, we're risk on, stocks are higher, yields are coming down, the dollar is coming down, the yen is going higher. Which stands out to you as sort of most full of messaging for the markets about what this news means?
I think the one that should be probably most sustainable is equities a bit higher, because this is a continuation of what was seen as the first leg of the Trump trade. I think the idea of dollar softness and yields lower on the Bessent announcement can't be that sustainable, given it goes contrary to what the narrative was about every other Trump appointment out there. But I think that the bigger picture of what this kind of highlights is that the amount of confusion about what the Trump administration will ultimately mean. At the moment in markets, we have coalesced around a consensus out there, and it's a consensus that the Trump administration will deliver almost all the things that are positive for the stock market, and will ultimately back away from almost all the things that are negative. And that's based on the narrative that ultimately one of his favorite barometers is the stock market itself, and therefore everything will be very business friendly. That might indeed end up being the case, but I'm very, very worried by the way the market is so quick to dismiss some of the policy suggestions that have been reiterated again and again that would be very damaging, as if they're just bluster and bluff, and yet he'll get away with all the positive ones. So I'm quite worried at the path from here and don't have much conviction.
So do the bears have to wait then?
I think that, for now, for this week short term, we're going to kind of basically run out of steam on the Bessent trade probably in the next 24 hours or so. And then I think we go into month end, we go into Thanksgiving. And I think for a while, we're going to go, hey, wait a sec. Trump doesn't come into power until January. We've priced in enough of those probabilities. Now we got to get back to the data. We got to get back to what the central bank paths. We've got jobs data, CPI. We've got the Fed coming up in December. It's going to be lower liquidity time. I think we're going to back off from trading those Trump trades, and then the Trump trades kind of come through again in January when we get more clarity.
Yes, and it's going to be a fairly busy week, is it, Mark, in terms of the data, and we get Fed minutes? What are you going to be watching for? PCE, does that stand out to you still? Are we still interested in that kind of slightly backward-looking data now, when we've got all kinds of expectations about inflation from here?
It is a bit backward looking, but I think the inflation story remains very important, because that's going to be one of the key metrics for how much of the Trump plans can be delivered, how aggressive they can be on the fiscal side, and what that kind of means for the bond market and yields. I think it's not going to be a particularly instructive week because of the low liquidity, because of the holiday, and also because of month-end rebalancing. So I think we can get some funny moves this week, and I think it would be problematic if you overinterpret the funny moves. So I think we've kind of got to write this week off, trade it short term. It'll be very much a trader's market this week. There will be opportunities, there will be overshoots, but it's not the macro message you take away from it.
Mark, thank you very much. Bloomberg Markets Live Executive Editor Mark Cudmore with some of those macro insights around the market. You can get plenty more of that. MLIV Go is the function to use on the Bloomberg terminal to get the thoughts of Mark and the rest of the Markets Live team. Let's go now to the stock-specific agenda. Joe Easton has a busy list of stocks that could be on the move this morning. Good morning, Joe.
Morning, Anna. So a busy day indeed, particularly in M&A over in Italy. We're seeing news that UniCredit launching a €10 billion bid for its rival BPM. Now, this is an all-share offer, and actually, as Guy was mentioning earlier, not a huge premium on this at all. But given it is all-share, it will depend on what happens to UniCredit's own stock over the next few weeks as this progresses. There's the year-to-date moves on those ones. But the one we're seeing weaker today is over in Germany, Commerzbank. Now, viewers will remember, of course, that UniCredit is potentially looking at a full bid at this one. This is what analysts and investors have been speculating, at least, and we can see that stock rallied on news of a potential UniCredit bid. So we're seeing that coming down today on the Tradegate exchange. And there is also broader read across for Italian banks, because we also saw speculation that BPM itself could bid for Monte Paschi, and that spurred a rally in Monte Paschi shares a couple of weeks ago. So if BPM is being taken over itself by UCG, then what does that leave Monte Paschi doing? Also, I've got my eye on the broader Italian banking stocks as well. There are actually 8 publicly traded Italian banks, more than twice as many as there are in Spain. A really fragmented market, so potentially there's going to be a bit of positivity feeding through into that more broadly. Then another M&A story coming through over the weekend is ITV potentially looking at some bidding interest coming through from CVC Capital and also an unnamed broadcaster. This is a report in Sky News at the weekend. Now, we have seen ITV shares coming off recently, given some really weak advertising sales. And if we look on the pre-pandemic basis over 5 years, it's lost half of its value since before the pandemic hit back in 2020, perhaps showing us why companies are looking at this as a potential bid prospect. The deal would potentially see it split between the broadcaster and also their studio business as well. Then in terms of auto, some pretty big news out of Reuters on the EV space, saying that there's potentially work going towards a deal between China and Europe, the EU, on EV sales, potentially a minimum price on EVs that are sold by China into the European Union. And we saw a rally in the Asia EV stocks on the back of these news. We can see some pretty decent gains for those stocks in China and Hong Kong. And there's 3 stocks in particular to watch in Europe: VW, also BMW and Mercedes, the German makers, all slammed this year, partly due to weakness on EVs, and a lot of that due to competition from China. Finally, in the ratings, there's some decent ones. We've got a buy for Santander. That's over at Morgan Stanley, who goes overweight. Barratt Redrow, the UK's biggest home builder, has a buy rating also at Jefferies. And finally, in EVs, Ørsted is cut at Goldman today.
Joe, great stuff. Thank you very much indeed. Some of the single stocks we're going to be watching, some of the sectors we're going to be paying attention to this morning. We're also continuing to get lines out of UniCredit. This call is ongoing with Orcel. No impact on the 2024 dividend for our shareholders as a result of what he's proposing in Italy, and committed to keep the dividend future policy unchanged.
Yeah, similar to the messages he was giving around Commerzbank. We're still going to be able to give money back to our shareholders even if we do this M&A. Interesting on Anglo American as well. Keep an eye on that one. They have said that they've agreed to sell their steelmaking coal business to Peabody Energy. That could raise as much as $3.78 billion. The Open is next. This is Bloomberg.
Monday morning, good morning. Let's talk about Friday, because Friday tells us absolutely nothing that is useful this morning. I may be overemphasising that a little bit, but this chart I don't think is that useful this morning, because what's happened subsequently is that we've had Scott Bessent named as Treasury Secretary. So this was the rally we got into the close Friday, the white line. The US kind of finishes roughly at the same level. There's not a great gap between them, so the arbitrage trade between the kind of US and Europe, the catch-up trade doesn't really exist, but the Bessent trade does, and that is why we're seeing futures doing what we're doing this morning. It does seem that we've got this risk-on sort of story coming into Thanksgiving week. The market's certainly giving thanks for Bessent. Look, you've got the Euro Stoxx 50 up by 0.8%. The FTSE's lagging a little bit, but the CAC is up by 0.8% as well. There's a number of factors in the London market which may just cause it to dip a little bit relative to the outperformance we're going to see elsewhere. But what we're seeing here basically is the risk rally coming on. You are seeing that reflected as well in what we're seeing in the bond market this morning. The dollar is down a little bit, which is another factor we need to think about as well, Anna. But there's quite a lot of single stock stories we need to talk about too.
Yeah, absolutely. Some single stock stories and some sectors that will be in focus. Italian banks, and such a big heavyweight on the Italian market that we'll keep an eye on the whole Italian market. The FTSE MIB in focus today. Banco BPM, could we see that one go higher on the back of this bid from UniCredit? UniCredit says it shouldn't be a surprise, and they don't want to reduce the amount of money they return to their own shareholders as a result of this. But the market is wondering what this deal, if it goes through, and a bid for Commerzbank, if they pursue it, what all of that would mean for UniCredit. So we'll see some movement there. EV makers in focus after that Reuters report talking about minimum pricing for Chinese imports. And Anglo American certainly in focus, selling their steelmaking coal business, simplifying, shrinking the business. You remember that BHP bid guide that they pushed back on?
Absolutely. We're starting to see some effect coming through from that. Right, here we go. Monday morning's opening trade. We're expecting the Bessent trade to be firmly on here in Europe, and the FTSE may be reflecting that least. So the FTSE's already up by 0.1%, but the IBEX in Spain is up by 0.6%. We're expecting similar numbers to be posted elsewhere around Europe, 6, 7, 0.8%. We are expecting from maybe the IBEX, the CAC, maybe the DAX as well. But we've got a lot of news coming out of the DAX a little bit later on. But the Stock 600 only up by 0.2%. Let's wait and see as we fold in some of the other numbers. The CAC's up by 4%, so maybe that Stock 600 number starts to climb a little bit. We'll wait and see exactly, Anna, what the DAX delivers in just a moment.
Yeah, absolutely. So we are seeing some positivity then coming through, certainly in the French market, waiting to see what we get on the DAX. As you pointed out, the Spanish market, usually quite high beta, isn't it? And that one is up by 0.8%. FTSE MIB up 0.5%. So we do see some strength coming through on that particular market as well. In terms of the individual sectors, no surprise, I suppose, when you see the French market doing so well, that consumer products and services is the best performing sector in Europe. And it's some of the luxury space there. It's also some of the home builders in that market as well. And in fact, real estate was one sector that did well at the end of last week. But this morning, it's Kering, Puma, LVMH, Moncler, but also Barrett Redrow in there with consumer products and services in that sector too. So it's sort of mixed bag, but luxury certainly to the fore. Autos is another strong performing sector. Volvo cars and some of the other BMW I can see is higher Lidl this morning.
Roche and Novartis are both soft. This is the points drag on the stock 600. They're the two biggest points drags. But UniCredit is the third biggest drag on the stock 600 this morning in terms of the news that we have seen regarding takeovers being folded in. Banks generally are a little bit weaker. Can't see any other kind of clear and obvious themes coming through this morning. Banks seem to be reasonably mixed. But as you say, it is actually maybe the luxury sector and the technology sector that are driving us higher this morning. LVMH up, ASML, SAP, Schneider, Airbus and Safran are both having a reasonably good day as well.
Yeah, worth noting that UniCredit, I'm not sure if you mentioned, is down by 1.2%.
Biggest drag, yeah.
Yeah. Sorry, you said. So that's worth noting, of course, given the focus that we have on M&A within the Italian banking sector. The FTSE MIB, as I say, is up by 0.5%. We'll keep an eye on the banking stocks there. In fact, hardly any stocks in Italy are in negative territory. It is a pretty risk-on day, and that probably has something to do with, yes, banking M&A, but also Scott Bessent. Let's talk about that. Patrick Armstrong, Group CIO at Plurimi Wealth Management, joins us now. Patrick, very good to have you with us. Happy Monday. It seems a happy Monday for markets. They seem to be welcoming the appointment of Scott Bessent, hedge fund manager, Wall Street's guy, seems to be the way that many have described him over the weekend, and a fiscal hawk. What does all of that add up to for you?
Yeah, it's not a bad news scenario, definitely, because with Trump's appointments, it could have been somebody who was very pro-tariffs, very much cutting taxes but no offsetting fiscal discipline. Those were the worries that Wall Street had. And I think Bessent, it's too early to say he's answered those worries, but based on what we know so far, I think that does alleviate some of those concerns. I know.
I wonder what the secret sauce is going to be, the secret answer. How are you going to get the budget deficit to 3%, but also cut taxes at the same time?
Not going to happen. In my opinion, populism is the overriding theme of Trump, of all of democracies in the West right now. And I think any unfunded tax cuts just go to bigger deficits, higher debt. I think that's the actual plan. Tariffs will be used as a soundbite that will basically reduce the deficit, but it won't be effective. So, in my opinion, yes, it's not going to reduce the deficit.
Do they offset tax cuts?
I don't think so at all, no. Tariffs give you a short boost in the dollar as it reduces demand for foreign currencies, but then when the retaliatory measures come in, it just reduces aggregate trade, and I don't think it's a big win by any means.
Inflationary?
Inflationary. Everything Trump does is unequivocally inflationary apart from the deregulation. So I think tax cuts boost demand, tariffs increase prices, unfunded debt create the need to print new money to pay off the old debt.
So do I buy stocks and sell bonds in that environment?
I hate treasuries. Treasuries yielding 4.3% are pricing a decade of perfection from the Fed. If you look at inflation break-evens over the next decade, 2.3% is what the market's pricing. And when you've got populism, you've got tariffs, you've got wars, you've got environmental issues, inflation is going to be much higher than the market's pricing. There's going to be intermittent spikes, and much prefer a tip. You get a real yield of 2.2% on a 30-year tip. So you're growing your purchasing power for the long-term risk-free. Buying a conventional treasury, I think you're going to lose purchasing power over the next decade.
So why do you think bond markets, we're seeing yields fall this morning on the Bessent news? They see the world's fiscal...
Yes.
They see him as bringing some fiscal discipline, but from what you've said...
I think that would be...
not that good reason for those yields to drop.
If he was putting his own policies in place, I think there would be fiscal discipline. I think he's going to have to not completely parrot Trump's policies. I think he'll present them in a more grown-up way. He'll push back on things, but everyone who's followed Trump knows what he wants to get through are short-term wins. Everything's going to be pro-growth. Whatever the problem is, fix it quickly, think about the long-term later, and that's populism and that's inflationary.
It's good for that. Maybe it's good for U.S. stocks. Is it in the short term or only in the short term?
It's good. Yeah, it's hard to say how there's anything bad news about this for U.S. stocks. He obviously has promised Trump he's going to implement the tariffs, but I think it's going to be in a much more grown-up way, not just sound bites that scare the market, and I think that's good news for equities.
But are equities going to be comfortable with the idea that yields go higher from here?
I think when you saw yields get to 4.5%, you saw some real weakness in...
what about 5? What about 6?
That's when things start to change, yeah.
Do we get there?
Next year, I think 10-year Treasury yields are above 5%, based on a Fed funds that gets to around 4.25, 4 maybe only, but you're going to have a normal term premium. If I'm right about inflation and the market starts to price in the risks of inflation, you have to be compensated with the term premium. So it wouldn't be outlandish to think if you've got the Fed at 4%, the 10-year yield's 5.5. That's just pretty normal historically.
Patrick, can I ask you about banking M&A? Seems to be a surprise topic of the morning. I mean, it's been around in the background for a long time, and it's something many people have talked about as being entirely necessary cross-border. UniCredit has ambitions in that space, but today is all about the domestic Italian M&A story. Can banking M&A deliver something material, do you think?
It's really got to turn into a cross-border M&A to really solve the problem of overbanked Europe and create some synergies, and you've not seen any impetus for that. Every country wants a strong national bank that they don't really, just for national pride reasons, I don't think they want to see merging with other countries. And
is the market, maybe the market is interpreting this Italian M&A story as meaning there will be less cross-border M&A. I mean, Commerzbank shares, for example, down more than 6% today as UniCredit makes that offer for Banco BPM. Andrea Orcel would like us to think that the business can pursue all of these things at the same time. But
I don't know if that's why it's down, or maybe they're down too, maybe thinking there will be bids for other companies too. It's an incredibly cheap sector, but the U.S. banks are quite cheap as well. And if I'm right about the yield curve, the U.S. banks are going to have a very strong interest rate margin that probably Europe's not going to get to, because you're not going to have the inflation, you're not going to have the growth in Europe, which leads me to prefer U.S. banks still.
U.S. stocks?
I'm underweight U.S. equities in my global portfolio. I've got 62% of my portfolio in the U.S., though, so I've got a lot of U.S. stocks. If you look at the MSCI World ex-U.S., it's at a record high, or the U.S. is at a record high multiple versus the rest of the world right now. So 22 times forecast, 12 months earnings versus 14. Year to date.
Where's the overweight?
So I'm overweight everything else but the U.S., but very slightly. So I'm overweight Japan, I'm overweight UK, pretty neutral on Europe right now.
So what does the portfolio look like in terms of its composition? A lot of stocks.
All the big cap U.S. companies, I still like them. They're very expensive, but they deserve the multiples they trade at. What I'm worried about in the U.S. is there's ancillary companies that are part of the AI trade that are all trading up with the mega cap companies, and I think the mega cap companies are the winners. They've already got clients. They're going to improve their pricing based on AI benefits. Companies that are trying to generate customers based on AI, it's much more difficult. So I really think the incumbents, the big mega cap tech, you've got to get them from the U.S. So I own those companies, but I'm underweight basically the second tier of tech that are trading at multiples that I think are a little bit too ambitious.
Do you see opportunities in AI in Europe, Patrick? It's always quite difficult to take Nvidia headlines and translate them into the European stock market. Do you see that as investable in Europe?
It's not. We're playing it through the U.S. It's a good question to ask, and there's probably good answers to it. I haven't found the good answer to it right now, but it's much more easy and clear how you can play it through U.S. companies right now.
And have we run into... Are you still... Where are you on that US AI trade then? Is there still...
So I own Nvidia, I own Google, I own Facebook, I own 4 of the big 6, basically, and I do think AI is real. I do think Nvidia just has such a clear revenue growth model because the companies that are buying their processing units are all companies that are so cash-rich that have promised their investors they're going to spend there. So I'm comfortable with the valuations there. They are a bit extended. They trade at 30-ish times earnings in aggregate, which makes sense given their growth, their profitability, their defendable market share. Regulation is a risk, obviously, and antitrust measures, but I don't think the U.S. is going to want to pull the carpet from underneath these companies as they're competing with China.
Can you see a catalyst to get U.S. stocks lower at this point?
Yeah, it's the 10-year Treasury. That's what it's going to be. It's going to be.
So where's the point? Where do I have to
So I think once you start getting above 4.5, we saw it a couple of weeks ago. There was some real weakness, not for long, for about 4 days in these stocks as 10-year yields hit 4.5. And as yields move higher, 2022 was terrible for big cap tech companies. And as yields move higher, there will come a point where 30 times multiples just aren't sustainable if you've got 5% Treasuries. So unexpected inflation is what kills Treasuries and big cap tech at the same time.
Wow, that sounds like it's pretty devastating for a 60-40 portfolio. Patrick, nice to see you. Thanks for stopping by to see us. Patrick Armstrong, Group CIO at Plurimi Wealth Management. Core 6 looks like this here in Europe this morning. These are the main stocks that are moving, as you can see. Everything looks higher. Luxury in particular, though, looks higher. You've got LVMH up by 2 and a bit percent, 2+%. But elsewhere, you are seeing a little bit of weakness. Maybe there's mixed story in the banking sector. Certainly that is a story that we're covering very carefully this morning. We've got news on Barclays too.
Do we want a story this morning that takes us back to the GFC? I have one for you if you want it. This is the UK FCA fining Barclays £40 million for failure in disclosure. And this goes back to the GFC, how each bank navigated that and survived that. Well, in the case of Barclays, they took an investment from the Qataris and they were found to have failed to disclose some details of that Qatari arrangement. And so that's what they're being fined for. Though Barclays saying there's no material financial impact and they already took a provision for this.
I was about to say, there must have been provision for this.
Yes.
They've had time to think about it.
They really have. And they took a provision in 2022 and it has no notable effect on the stock. I mean, the stock is still in positive territory, but that's just a line in the sand, perhaps, on that particular story post GFC. Let's get some of the other stock movers that are very much in the mix, sticking with the banking sector, but over in Italy, Joe.
So there's a lot of action in these banking stocks this morning, Anna, particularly in Italy, as you say. Now, Banco BPM, we've just got an opening price on that one, coming up around 5% at the moment. Now, remember, the UniCredit implied takeover bid, it's actually only around €6.5 a share, so we are seeing it coming up significantly higher than that on the early prices, given that takeover deal potentially coming through. UniCredit falling. Guy and Anna have been discussing the comments from Orcel, speaking in a conference call, saying this should not be a surprise. But we are seeing their own share price coming down a bit. And the one really hit is Commerzbank, because remember that UniCredit was potentially looking at a bid for Commerzbank. That's what's been speculated, at least. And that one is falling 5% at the moment. Monte Paschi I had as well, because BPM itself was actually a potential touted bidder for Paschi. So many moving parts to keep on top of. But we are seeing some decent moves in those, particularly BPM and Commerzbank, really the big ones impacted by that really interesting news of a potential progression on Italian banking M&A. Then, speaking of M&A, we've got ITV, this report coming from Sky that CVC and an unnamed broadcaster are looking at the UK company, seeing the stock coming up around 8% at the moment. ITV has kind of been a perennial touted takeover target. Potentially, will we actually see this finally materialise for the company? We'll have to wait and see on that one. Then Anglo offloading their steel-making coal business. This is to Peabody Energy over in America. It's about $3.8 billion. But as was discussed as well earlier on the show, this was something that was speculated when BHP looked to try and buy Anglo. Anglo rebuffed it, but everyone said they might potentially look to sell that business anyway. So we're seeing it up only around 2.4% at the moment, but nonetheless, a bit of movement on that one. Then we've got the EV makers following this report. Now, this is actually coming from NTV. I believe this is a German publication, but also picked up by others, including Reuters and us as well. And we're seeing, again, in the German EV makers, the German automakers with EV exposure, potentially minimum pricing on Chinese EVs in Europe. That could potentially be positive for these companies, and they are gaining today. And then in terms of a UK earnings, another negative one from the B&Q DIY maker. We all love to go down to B&Q and buy our DIY supplies, but that one slammed down 10%. They're warning once again of weakness in the UK. Now, France is also pretty soft, but that's a smaller market. The UK growth only around half of what analysts expected in the last quarter, and on a yearly basis it is actually still in negative territory for the B&Q and Screwfix owners. That one down 11% today. And then finally, in ratings changes, mentioned Santander. Now, Morgan Stanley likes banks that have minimal rates exposure but higher exposure to fees and also strong capital. Santander is one of their top picks. Pretty interesting, given we've seen news of a potential windfall tax in Spain. They still like the stock, and Santander rising today 1.4% in Madrid this morning.
Joe. Thank you very much, Joe Easton, from our equities team, with all of the equities individual stock news you need. UniCredit, a couple of other lines coming through from Orcel then, Guy, just this morning, saying as of today, Commerzbank is a financial investment. So we've heard that line before, limiting expectations perhaps there. And he's talked about not going after the rest of it until after the German election. UniCredit has no ambition on Monte Paschi, which is interesting because some people have joined the dots and said, well, maybe the reason he's going after BPM is because BPM's been going after Monte Paschi. But here he says no.
Yeah, there was this whole idea that maybe this could just be a giant Italian roll-up. You could do a whole series of transactions in one and achieve multiple aims with that. Maybe he's pouring a little bit of cold water on that, maybe aware of the regulatory risk of trying to do so much and how much consolidation will be tolerated by Italian politicians. Anyway, coming up, we're going to take you to another sector here in Europe. There are reports that Brussels and Beijing are nearing a solution over EU tariffs on Chinese EV imports. We'll talk about that next. This is Bloomberg.
Welcome back to the opening trade. We are nearly 20 minutes into what's been an eventful session. Big picture, we're factoring in some risk-on moves across European stocks, as we did in Asia, because of the appointment of Scott Bessent in Treasury over in the United States. But underneath that sort of macro narrative, we have some sector-specific stories that we really need to revisit. So we'll do that now. And first, we'll go to the banking sector. UniCredit and BPM, the share prices of both of those very much on the move. BPM moving higher, UniCredit moving down, after UniCredit has launched a €10 billion all-share offer for the domestic rival Banco BPM, opening a second major takeover front as CEO Andrea Orcel also pursues Commerzbank. Let's bring in Bloomberg's Southern Europe managing editor, Tommaso Erpart, who's all over this story for us. Tommaso, take us through some things, some details perhaps around Banco BPM and what it is that UniCredit is trying to do here, because it's interesting that there didn't seem to be a premium on this deal, and yet the BPM share price goes higher. So what are we missing on that story?
So good morning. This was the 6 a.m. Monday move by Andrea Orcel. Somehow he moved back from Germany to Milan, bidding for Italy's third largest bank. Why it's so interesting? Because just a few days ago, Banco BPM had bought a stake in Banca Monte dei Paschi di Siena, and we know for a fact that the Italian government wanted to create a third banking group around Monte dei Paschi di Siena. For now, we don't have any response from the Italian government if they will approve, if they will not approve the move. And also, Banco BPM has an important investor among its shareholders. Crédit Agricole, the French bank, has about 9% of Banco BPM. So the reason why Banco BPM is going up is probably, we can guess, that investor may think this is just the beginning and not the end of a battle for the bank. I'm just guessing.
Yeah. Tommaso, when Giorgia Meloni woke up this morning to this news, how do you think she would have reacted? Is this something the Italian government will be in favour of? You say we don't know at this point, but do we have an idea of the kind of landscape that Rome is looking for in Italian banking?
So on one side, that Banco BPM was a potential target for UniCredit has been in the card for months. It's a very rich bank based in Lombardy. And UniCredit could expand in Italy with Banco BPM. And that's for sure a good fit for Orcel, and speculation about the possible bid of Banco BPM have been going on for months, not for years. So not a total surprise. The surprise probably is in timing, just because a very few days ago, Banco BPM bought a stake in Paschi, and a few days before, Banco BPM launched a takeover bid on asset manager Anima. So obviously, this is like the third move, and a very bold move by Andrea Orcel on Banco BPM. We'll see if Italy sees this as a good deal for the country, creating a big Italian champion to rival Intesa Sanpaolo, or if the Italian government would favor a third banking group. But this is left somehow to the market, and Andrea Orcel made moves. So now it's up probably to Banco BPM investor to see if this is a good deal for them or not.
OK, we'll get that verdict, perhaps. We'll watch for further developments behind this share price move this morning. What links do we draw between this and appreciating your focus is Southern Europe, Tommaso, but what links with Commerzbank? Because the market seems to be suggesting that Orcel can't go after all of these things at the same time, because Commerzbank is down by 5.5% this morning.
Yeah. So first of all, Andrea Orcel is going for big deals. So I don't think that a Banco BPM move means really anything substantial on Commerzbank. But this is what investors are reading in the morning. If Commerzbank fell almost 6% at the opening, so it looks like, at least from a market moving point of view, that somehow Orcel is focusing on Italy after being focused on Germany for some months. But we'll see. He said on a call very few minutes ago that for now, Commerzbank is a financial investment. So you can read it as a little bit of cold water on potential takeover of Commerzbank. We don't know. We'll find out. Our reporter, Sonia Cisleti, is on the field. So for sure, you will read it first on Bloomberg News.
We certainly will. Tommaso, looking forward to that. Thank you very much indeed. Tommaso Eparts joining us, Southern European Managing Editor, covering the banking story for us this morning. Shares in European EV makers trading a little higher this morning. This on reports that the EU and China are nearing an agreement on import tariffs. That's according to a report from the German broadcaster NTV. For more details, we're joined now by Craig Trudell, Bloomberg's Global Autos Editor. So the idea here is that we get a minimum price in Europe for Chinese EV imports, which sounds great for the Chinese. I'm trying to work out why it's good news for Europe.
Yeah, I do kind of wonder just how much stock we should put into this for that very reason. You have this information coming from a German politician. We know that Germany has come out forcefully against these tariffs, was not in favor with going forward with them, and wants them to go away. And so a question of, the source of this information from the sort of from the jump. But also, I think if you actually look at the comments that were made, the level of detail is quite vague. So we've known for weeks now that there have been these discussions about price undertakings and trying to set a floor. There's real question as to whether that would be more effective and more sort of helpful to the European industry, as opposed to putting in place tariffs that would lead these companies to set up local manufacturing, which I think is what other parts of Europe would prefer. Germany, of course, what they're concerned about is making these tariffs go away so that there aren't retaliatory tariffs put in place that would hurt their manufacturers.
And Craig, just briefly, I mean, this would be a hard sell to the electorate, would it? That, look what we've done. We've done a deal that means you will pay more for your cars than you might otherwise have.
I think in both cases, whether it's tariffs or these price minimums, you're making it more expensive for people to make this transition, which is the very issue that we've been talking about, sort of ad nauseum for months and years now, that electric vehicles are still much more expensive than combustion cars. And when you put these measures in place, it actually makes this transition more difficult.
Craig, thank you very much. Thanks for joining us. Bloomberg's Craig Trudell. We spent a lot of last week, of course, talking about Ukraine and escalation in Ukraine. We will discuss what Donald Trump's new administration means for Russia's war in Ukraine. That market focus, no doubt, will return. So we'll get to that conversation. That's next. This is Bloomberg. Welcome back, everybody. This is the opening trade. It's Monday morning. We have green on the screen, though, as delivered by the new Treasury Secretary, perhaps. We see a little bit of risk on in Europe. Some of it's faded, though, even in just the first half hour. So the CAC 40 started out of the gates up by more than 1%. Now it is just up by 0.5%. So we do see positivity, Guy, but not quite as much as we had. We've been dealing with a lot of interesting sector-specific stories. We have plenty of geopolitics that lingers in the background as well.
Geopolitics, got banking, got all kinds of things going on this morning. Anna's bringing up the fact that maybe last week I thought the year was over and we could basically all rest easy, but it does seem a few things that we need to work our way through. One of which is, of course, what's happening with the Trump cabinet. We now have the final piece in the puzzle. Donald Trump has filled his cabinet with people he wants to carry out his America First policies. the economy, the border, national security, etc., etc. In a nod to Wall Street, hedge fund manager Scott Bessent has been nominated to the US Treasury Secretary. Chris here with more details.
Guy, Anna, let's talk about what he's actually advocating for here. We heard about this plenty on the campaign trail with President-elect Donald Trump saying we need to address the budget, we need to decrease taxes, and we need to increase tariffs. How do you do it without shaking the financial balance sheet of the U.S. government? Well, that's Scott Bessent's job, and he's advocating it through a 3-3-3 policy, taking a page out of the Shinzo Abe playbook of all places. Remember, for Japan, that works, but Japan's a very different economy than, of course, the United States. But here's what that means. It means cutting the budget deficit to by about 3% to 2028. I'm going to show you what that looks like in just a moment, but stick with me here. He's also talking about deregulation. It's not just about tax cuts. It's also about getting more tax revenue by having more growth, and some of that is spurred by taxes, other is by other incentives. What those other incentives are, we don't actually know, but it's something that he's talked about, not to mention the energy sector. And we're talking about oil, we're talking about natural gas, we're even talking about electricity to power some of the AI story. That's where producing an additional 3 million barrels of oil per day comes in handy. But it comes all right back to the deficit, because none of this is possible if you can't balance the books. And that's where I want to go next. The idea here that by 2026, you are still looking at a minus 6% on the U.S. deficit, something that isn't really changing going back to even right now in 2024. It is getting worse and worse in the last couple of years. More spending by the U.S. government, really relying on being the U.S. kind of reserve currency, the bond market that has extreme liquidity relative to the rest of the world. Here's where it shows up, though. It shows up in those tariff-exposed currencies. If you are balancing the books, if you have less taxes, where do you make up the difference? It's tariffs. It's Europe, it's China, it's Mexico, and it's Canada. And here's where the geopolitics could show up. Guy and Anna.
Critty, great stuff. Thanks. Critty will be back tomorrow, I think. Looking forward to that. Missing her. Let's talk a little bit about what is happening with those geopolitics that she mentions and how it's being folded into the story. We're keeping a firm eye. In fact, last week was dominated by news around Ukraine. So let's carry on that conversation. President Joe Biden pushing to strengthen Ukraine's position against Russia before Donald Trump's return to the White House. The president-elect, of course, has pledged to end the war started by Vladimir Putin almost 3 years ago. I think it's 1,000 days plus a few now. Let's discuss the new administration and what it could mean for Putin and for Ukraine. We're joined by Tim Ash, Senior Sovereign Strategist at RBC Blue Bay Asset Management, an Associate Fellow at Chatham House. Good morning. What happens next?
Well, there will be negotiations. It's pretty clear, I think, for the last 6 months that whoever won the presidential election in the US, that was going to be the case. Zelensky was obviously waiting for Harris win, thought it would improve his position. Putin obviously wanted a Trump victory, assuming that would help his position. But I think both sides can fight the long war. You know, obviously, Putin's got there's a lot of durability. The North Koreans have come in to help him recently. But again, Ukraine's fighting for its survival, for its life. Ukrainians are not just going to run away, walk away. They have to fight because it's their territory. And they've proved durability and also an ability to fight a long war. But I think both sides ultimately would like a settlement at this point in time for different reasons. The risks to both sides from a continued war. So there's a deal to be made. We're just waiting, I think, for the Trump presidency, for the new team to come in and actually negotiate, try and negotiate that.
Does Europe have a seat at that table, and what does Europe need out of this?
Well, obviously, the Trump administration would like Ukraine just to go away. They want to focus on China. The US sees China as the primary risk. I would argue Europe sees Russia now as a primary risk. So I don't think Europe's going to walk away because they want a settlement that makes Ukraine sustainable. The worst case for Europe is that Trump walks away or imposes a deal that means that Ukraine is not secure, the peace is not durable, Russia goes in again. What does that mean? It means that there'll be no investment into Ukraine. Ukraine will economically fail, socially and politically ultimately could fail. Imagine 1 million Ukrainians.
Is that okay for Putin? Is Putin?
Well, Putin loves that scenario. Putin wants a scenario, a peace that is not secure for Ukraine because he wants to go back in again at a later date. Now, just imagine for Europe what that means. If Ukraine fails, if 1 million soldiers come back, they don't get any improvement in their lives. You see political change in Kiev. You could see state failure in Ukraine. You could see Putin come back in, take the whole country. Millions of Ukrainians, tens of millions of Ukrainians moving west. Imagine Russia getting Ukraine's military-industrial complex. The Ukrainians have made huge advances in 1,000 days of war. They have a really capable military-industrial complex. If Russia gets that combined with its own, it's a huge threat, future threat to Europe. So Europe cannot just leave Ukraine alone because Trump, is not interested in Ukraine. They have to remain committed to helping Ukraine sustain its own defence, because it's in their interest.
Yes. So is there a settlement that you could see Trump and Putin agreeing to that would be sustainable? Because it sounds from what you've described there is there will always be an overhang, a Putin overhang over Ukraine.
Yeah. I think the key debate will be about security. There's a lot of focus on territory. I think the Trump guys just want the conflict frozen where it is. For me, there's debates obviously about NATO membership. This war was never about NATO. Putin invaded Ukraine because he wanted the whole of Ukraine. NATO was no threat to Russia. Ukraine didn't want to be in NATO, actually, if you go back to 2014. It was about Putin's colonial ambitions to Ukraine, right? So I think, NATO is less important. What is important is Ukraine's ability to defend itself. Now, either it could be security guarantees. I think NATO members will be nervous about that. If you don't want to give NATO membership, why give security guarantees, which in the end would pull you in, ultimately will pull NATO into a future war. Yeah. I think what the deal could be is NATO gives Ukraine the kind of security guarantees that Israel has. Ukraine will get whatever weapons it needs conventionally to defend itself. Ukraine's proven more than capable of defending itself. Its problem is we haven't supplied it with the financing and munitions to enable it to defend itself. So if they get, cast iron assurances that they get exactly what Israel gets or South Korea gets, I think they can actually be secure, and Russia would be deterred from future invasion, which means the country would have a future.
And it would have a future, and it would have an investment future. Money would flow into Ukraine in that scenario.
Absolutely. I mean, I think what is currently occupied by Ukraine is absolutely sustainable. You'll see a lot of financing flow into the country. It's a low base, big reconstruction opportunities. The agro-food sector is incredibly interesting. The military-industrial complex, again, is hugely interesting to Western countries, given that Russia is a long-term threat to Europe, to European Union politicians. I mean, look at the rhetoric coming out of Western politicians since the US election. Macron, Starmer. The message is all about, actually, Russia is the threat.
And will Europe have a different policy then around Ukraine and Putin versus the United States? Will we see divergence there?
Sure. I mean, obviously, lots of criticism of Trump, about his position on NATO, about Europe, all that. But I think there's been recognition that Europe has to stand up for itself. It has to fund its own defence. It has to wake up. How much does that
cost? How much does securing Ukraine, effectively some sort of Marshall Plan, effectively for Ukraine in terms of the rebuilding, plus rearming Western Europe, how much does all that cost?
Well, specifically on Ukraine, we've been spending about $100 billion a year to keep Ukraine just in the war. I would estimate for Ukraine to win, it should have been $150 billion. Assuming the war ends, reconstruction needs between $500 billion and $800 billion. Small economy, maybe $50 billion a year. I mean, they're doable when you think of the size of the European economy. And then there's the cost of Europe's own defence. There's a lot of focus on getting up to the 2% of GDP NATO target. Most countries have more or less done it now. I would argue, given the threat from Russia that's been proven, we need to go to where we were in the Cold War. We're talking about 3% of GDP plus. Some countries like Poland are up to 4 or 5%. But, I'd say we need to spend at least another 1% of GDP in Europe on defence. I mean, that's hundreds of billions of dollars of additional defence spending for Europe. I mean, it's kind of ironic that I mentioned that the $150 billion a year for Ukraine to win the war, we should have provided that. We didn't. The result of not winning the war, in effect, is that Europe is on the hook for hundreds of billions of dollars a year in additional defence spending. Cost-benefit, we should have done more to support Ukraine. That's the reality.
What do we make of the Romania story then, Tim? Well, we're thinking about this region. We have a pro-Putin candidate who's doing very well and will probably be in the runoffs on December 8th.
Well, extraordinary result. I was listening to a Romanian analyst last week, and I asked the question about the chances of such an outcome. And he put a 1% probability on it. I mean, I guess it shows that populism is popular. And, the Trump scenario, if you add a bit of xenophobia into the kind of the mix, it's kind of a winning formula.
It's popular with the young, though, as well, isn't it?
Well, yeah, I would step back a little bit. I mean, I think this election will mirror the election in Moldova recently. The Moldovan and Romanian populations are very similar, same language, similar kind of history. I think in the end, when it came to it, if you remember with the presidential election there, Romanians thought long and hard about it, and Moldovans thought long and hard about it. In the end, it was 55-45 for the pro-EU candidate. Romania gets a huge amount of EU structural fund flows, huge amount. You're talking 3, 4, 5% of GDP, massive. I mean, if we see this candidate, the hard right candidate, win, I think those funds would be under threat. So I think in the end, Romanians, a month down the line, we have parliamentary elections in 2 weeks and then repeat presidentials. Romanians will, I think, ultimately vote for Lasconi, who's the pro-EU candidate.
It does bring into question, though, this whole idea that Europe sees Putin as the threat, though. Western Europe does. Does Europe?
Well, look, I think it's pretty clear. Europe divides fairly clearly now. I think Poland, the Baltic states, clear-cut in terms of where they see the threat.
Yep.
The Scandinavian countries, the fact that Finland, Sweden remarkably came off the fence and joined NATO. Opinion polls shifted. I mean, the closer you are to Russia, the kind of, I think, more sense of the impending
Romania
peril.
has a big Ukrainian border, though.
You know, again, it's you know, this guy got 20% of the vote. Let's not over-egg the situation. Again, the proof of the pudding will be in the parliamentary elections and presidentials coming down the line. I would still think Romania split 60-40 pro-EU ultimately. But there is, you know, the support for this nationalist candidate is not. It's not just about just a pro-Russian vote. It's about immigrants. It's about you know, a liberal social agenda. A lot of the population in many of these countries are socially conservative. They don't really like that. We've seen a similar agenda play out in Georgia. Georgia Dream again pushed a socially liberal agenda. Conservative populations, rural populations, typically kind of like that. But in the end, going back to Romania, you know, when push comes to shove, what will they vote for? EU or something else? Which is pretty uncertain. I think ultimately they will go for the pro-EU candidate, but it's a shock. And I think politicians and policymakers in Romania have kind of messed around in politics. I mean, you've had unstable coalitions, you've seen squabbling about ministerial posts, etc. I mean, they just need to get on and govern properly and in an efficient way. And I think then they'll be rewarded by the electorate ultimately. But it's a wake-up call, absolutely.
Tim, thank you very much. We really appreciate your contribution this morning. Tim Ash, a senior sovereign strategist at RBC Blue Bay Asset Management and associate fellow at Chatham House. Coming up on the programme, Amazon is going all in on chips in a bid to reduce its reliance on AI powerhouse Nvidia. We will dig into that really fascinating big take story. That's next. This is Bloomberg.
I don't know what's going to happen with the new administration, but whatever happens, we'll balance simultaneously compliance with laws and policies, continue to advance our technology and support and serve customers all over the world. We'll continue to do that, and we'll be able to do that just fine.
That was the Nvidia boss. You might not recognise him in those clothes, but that was Jensen Huang speaking at a university ceremony in Hong Kong. I think he was receiving an award, but at the same time, we managed to get some thoughts from him, his take on the impact of a Donald Trump presidency, another one, of course. Now, let's talk about technology. Let's stick with that Nvidia theme. In the past 2 years, Nvidia has become the main supplier of the hardware that enables generative AI, making the company the world's largest by market value. But some of the chip makers' biggest customers are cooking up their own silicon. In today's Big Take, we look at Amazon's plans to build self-sufficiency in chips. We're joined now by Bloomberg technology editor Olivia Solon on set with us here in London. Olivia, very nice to meet you. So why is Amazon deciding to make its own chips? It's gone through the kind of complicated buy or make decision and decided we're not going to buy so many, we're going to make our own. What's the thinking?
Well, Amazon, like Google and Microsoft, has been very heavily reliant on Nvidia chips for generative AI. But there's huge demand for Nvidia's chips, which means they're very expensive and in short supply. So Amazon wants to bring some of that in-house to cut costs and also to kind of bring security to its supply chain.
That sounds easy.
Yeah.
Assuming it's not.
Right. No, they've been working on this for quite a long time. I think this chip that they're working on right now is actually their third-generation AI chip. The previous two, I think one was used for some of their Alexa stuff, and they've been bringing some into their data centres. But this third one, called Trainium 2, is sort of the real push to try and compete more closely with Nvidia, at least for some processes within their data centres. And they want to start as soon as this year.
So, I mean, there's been a lot of talk about Nvidia and the competitive landscape and where the competition is going to come from, because it's been making all the running in these AI tools for data centers, and lots of people are going to want to do it as well. So, cutting to the chase, will Amazon ever be able to either reduce or get rid of its reliance on Nvidia?
Well, Nvidia clearly has a huge head start, so it's going to be a big challenge. But Amazon does have a history of making its own chips, particularly for its data centers, where it's already pushed out a few other companies who were previously, third-party companies making chips for it. I think one of the key challenges for Amazon is going to be the software side of things. Nvidia's built this incredible ecosystem that makes it very easy for people to build their own AI tools using its technology. So Amazon will really need to match that if it wants to lure any clients.
Is the challenge actually in the silicon, or is the challenge in the software?
It's both, but I think the thing that Nvidia has a very, very big head start on is the software, and Amazon really needs to work on that part.
Okay. How close are we? Is this something they could be doing this year, next year? Because this could have a massive impact on the valuation of Nvidia.
Yeah, so Amazon has a couple of customers I think it's testing with. One of them's Databricks, and it says it plans to start using some of these things within its data centers by the end of this year. Yep. But it's not going to be doing exactly the same thing as Nvidia at this point. I think that the best kind of possible outcome for Amazon will probably be moving some of its own internal AI processes to its own chips, freeing up the Nvidia chips for more advanced processes.
That sounds quite remarkably logical, Olivia. Thank you very much indeed. Olivia Solon, the fantastic big take. That's the new oil, so data's the new oil. Let's talk about the old
oil, the old stuff.
which is oil.
Yes.
It's quite a big week, actually, coming up. So Bessent's really interesting in terms of this story. Scott Bessent, the new Treasury Secretary, coming in. He's definitely in the drill, baby, drill camp. You were talking about the three arrows earlier. One of those three arrows is an awful lot of oil coming into the US market. You've also got this OPEC meeting coming up at the back end of the week, kind of around Thanksgiving. Two really interesting interactions.
Yes, I think the OPEC meeting, comes next weekend, doesn't it? Back end of next weekend, so we've got a bit of time to go until then. But we do have weakness, quite substantial weakness in oil this morning, down 0.6% on Brent. Maybe that is the Bessent factor, the fact that there could be more supply coming in from the United States. That's certainly one thing that we're going to be watching for this week.
But he's also talking about the idea that he wants higher growth. Does one offset the other? I think is something that we need to be thinking about as well. In terms of the growth narrative, if the US grows faster, does it consume more oil? But also, there's this whole idea that maybe the Trump administration uses oil to offset the inflationary effect that we're going to see coming through from kind of maybe tariffs, etc. So you have a low energy cost, which is great. So they've got a lot of gas, cheap oil. You then put higher tariffs on, one kind of balances out the other. Maybe.
Interested in the three arrows and which ones of these are going to end up being deliverable. We spoke to a couple of guests this morning who sort of poured cold water on the idea that he'll get to one of the arrows, which is a 3% deficit in the United States. So whether the oil is going to be more achievable, we'll see.
Let's find out. So let's get more information on this and the impact that the new Treasury Secretary could have. Anthony DePaolo joining us out of Dubai to give us a take from there. Anthony, what is the perception within the oil market about what Scott Bessent as Treasury Secretary will mean?
Yeah, good morning, Guy. Interesting that he talked about those 3 million barrels of additional oil. We had heard from candidate Trump, now President-elect Trump, that he wanted to bring some more oil on. The industry is relatively skeptical about that because they're just saying there's potentially not that much room to bring more oil on in terms of supply already in the market, in terms of demand. And really, they're saying that the U.S. shale industry is more intent on returning earnings and profitability to shareholders rather than investing and doubling down in additional production. And you've also got to look at the oil price there as well, too. Is the price high enough to really incentivize these companies to bring more production to market and to invest more? We've seen some slight declines in the rig count there, some additional increases in storage. So the market is challenging. It's not a market that looks great for bringing more oil on. Certainly people want to sell what they've got, but really doubling down to make major increases, we're not really seeing that. And we're not really seeing that in the estimates that analysts have of new oil coming on from the United States.
Yeah, that'll be really interesting to see whether the actual US oil industry is on the same page as Bessent then and indeed as Trump on this matter and how much the US wants to produce right now. What position does this put OPEC Plus in? Because the focus for OPEC Plus has all been about not bringing back that oil supply because there was fears with China weakness and, China weakness mostly, I think, that there had been too much oil supply. And so that's where the focus has been. What does all of this mean for OPEC Plus into 2025?
Yeah, well, OPEC Plus is supposed to meet at the beginning of next week, so December 1st. They've got a meeting scheduled where they're supposed to come together and decide what the immediate term steps are going forward. Over the course of next year in 2025, they're supposed to unroll fully those production cuts that they have in place, bringing back an additional 2 million plus barrels to the market. Well, that exceeds the forecast for demand increase next year, even apart from all the non-OPEC Plus supply that's going to be coming on. That is more than 1 million barrels from the United States, from places like Brazil, Guyana, Canada. So other non-OPEC Plus countries will be bringing oil to market that's going to take up most of that demand. And so that's not really leaving any space for OPEC to bring barrels back to the market. They need to decide as well whether they're going to go ahead with that first round of unrolling. So far, they've delayed it already several times. The market expectation is that they will delay that again. But of course, for OPEC, kind of the answer is staring them in the face, which is bring that oil back, bring the prices down, and that knocks some of that shale and some of those new incremental productions off the market and gets them back into market share, but at that lower price level, which really isn't what they want. So the answer is there, but it's not really a palatable answer for OPEC. So the market expectation is that they'll see them kicking that can down the road, keeping production off the market so far.
Seems to be the strategy thus far. Anthony, thanks for the update. Really appreciate it. Anthony DePaola joining us on the oil market out of Dubai. So what have we learned this morning? We've learned that the market likes Scott Bessent. That seems to be certainly the narrative. The dollar's dipping a little bit, but equities largely seem to be pretty happy. We've got news on UniCredit this morning, which has been the real surprise of the morning.
Yes.
In terms of the bid for BPM.
Yeah, absolutely. So UniCredit making this bid for BPM and the market concluding that that's going to, either for regulatory reasons or management bandwidth reasons, not necessarily for capital reasons, but it's going to make it more difficult for them to go after Commerzbank in the short term, even though we'd already heard from Orcel that he wasn't going to go after Commerzbank until, if he does at all, until after a German election. So it's sort of parked, that one, for now, isn't it, on multiple fronts. But M&A within Italy seems to be back very much on the agenda.
So you downgrade, if you're in merger arbitrage kind of trade, you're trying to work out what the relative percentages of all these deals getting done, you certainly downgrade Commerzbank a bit. Is it off the table? Probably not. It's interesting that the premium on BPM has risen a little bit, but not by much. We're only up around 3% this morning. Would there be somebody else coming in?
That's what we've been trying to explore. Yes, and we were reminded there's a French bank that has a stake in BPM. Agricole has a stake, and so, might there be interest there? We haven't heard from them yet, so we'll watch and wait and see what develops on that particular front. We're going to get some data shortly out on Germany, the IFO numbers out on Germany, which takes us back to the back end of last week where we were all digesting the weakness in the European PMI data. Today seems different with the Bessent effect, a little bit more risk on, but that weakness in Europe still part of the conversation.
I think Thomas Fuss is going to be joining the Pulse in the next hour. Looking forward to that conversation, get his assessment of what is happening with this German economy into the German election. That's coming up. This is Bloomberg.